The market is open and we can actually see quite a lot of red and double digits in fact, and these are mainly the companies that have reported today that we are going to cover. As we can see, it was a very busy morning in the market, and today we are looking at the earnings and our own valuation of PayPal, PepsiCo, Merck Co, as well as Estee Lauder, which most of them have in fact suffered some very large losses. We're going to start off with Merck Co. We'll also discuss their earnings, but they are down around 10% just after the market open. I mean, over the last year, they have had a very poor performance, negative 29%. Over the last 10 years, not great either, up 52% on both accounts, underperforming the S&P 500, and right now they are trading in fact in new 52-week low territory. Having said that, Seeking Alpha believe now is a great time to add to the position. They've given it a strong buy. Wall Street themselves also consider this a buy rating, and they also pay a dividend. We are talking now well over the 3% mark. So let's understand what was the issue, why is this company down, and should we in fact consider it based on our own valuation and margin of safety. And we can see here their 2025 revenue outlook does fall short as they pause on the vaccine shipments to China. So let's take a look at the specific numbers, maybe read a little bit into this as well as the guidance that they are expecting. And now we can see for 2025 they expect full year revenue of 64 to around 65, which is actually lower than what the market wanted at 67 billion. Now you can argue that isn't a massive decrease, but as we say, companies do get punished if they don't at a bare minimum for guidance come in line. Merck Co have fallen victim to that. And we can see one of the reasons why they do fall short on this is due to the fact that the sales range reflects a decision to halt their shipments of Gardasil into China beginning in February through and going at least until mid-2025, and that is why we are seeing the drop in relation by around $2 billion. As we do come along to see the earnings per share that they released, $1.72, which is good because it is above the 162, and also the revenue. So look, bear in mind, whilst guidance has come in lower, management have shown they can beat the market. 15.62 billion above the 15.49, and they also posted a bottom line net income 3.74 billion, and we do quite like this. Bear in mind they did report in the same quarter last year a net loss of 1.23 billion. We can also see that essentially their revenue for this quarter is up 7% from the same quarter last year, which is fairly positive. We're not talking about a massive growth company, so it is up in the mid to high single digits. It is above the 4% inflation rate, but we can see for Merck Co, guidance has ultimately affected this company, which as we can see, they are pretty much a company like they did in just this quarter that do outperform management's targets. So that does give you faith when we do look to their expectations for FY25. They will be able to hit that, and based on the full year of 921, this is a company now with a forward P sitting below 11 at 10.84. If we look, the valuation is an A+. Two reasons for this. Firstly, on a forward P basis, they are now trading lower than the sector median, so in essence, you are getting a discount. But on top of that, as we will come to show you as well, they are trading lower than their historical 5-year average, and there are no surprises then why we do get a strong buy from Seeking Alpha and Wall Street deep into the buy territory, in fact near the 4.5 to flip this into a strong buy. Growth also looks good with an A. Revenue year on year, now 6.5%. It is lower than the sector median as well as lower than their 5-year average. Moving forwards, the same to be expected for both below the comparative of the sector at 7 and the 5-year of 6.12. However, what does really shine a light for this company, giving them the A rating, is the earnings per share expected to grow at 37% year on year over the next 3 to 5 years, above the 11% and above the 17% from both comparatives, which is very strong. We do want to be investing or consider investing in companies not only at attractive valuations but also that do have some growth pending over the longer term. Profitability A+, so great to see. We do like the fact that gross margin again above both comparatives, the 58 and 73, and the same to be said for the bottom line net income, 19.2 above the sector median, who are actually losing money, -5%, and above their own 5-year average. and this company does generate a significant amount of cash from operations, 18.3 billion, above the negative 15 million, as we said, sector losing money, but also above their own comparative figure. We also want to highlight that the dividend score does look to be very safe at 90, and we do also have a double undervaluation signal here, 3.66 above the 5-year of 3.01, and as we showed earlier, they are currently trading lower than their 5-year average, sitting in the mid 13.5. As we said, each one of these companies we're going to run through our own valuation process. Based on the updated numbers for this company, we sit intrinsically at 118. Now, typically on this channel, we do deep dives going through each model. Today, getting straight to it, we've got a few companies to cover. We're going to start off with a 10% margin of safety, execute on that if it meets our 3 golden criteria. Wide moat, strong financial metrics, good forward-looking data. If you believe that today, a buy around $106, and as we keep going, we can in fact seeing you are getting pretty much a 25% MOS even after the drop, with Wall Street themselves near a strong buy rating, $115 price target. That is upside of 29%. Definitely one to consider, especially if you want a company in the pharma industry. It has dropped, so maybe a good time to buy the dip. Yield does look very healthy, as we saw a very safe dividend score, but as always, give us your thoughts in the comments below. Before we move on to the next one, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks, as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to a recently released copy of 45 stocks that are undervalued for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 43 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to Estee Lauder, which looks like it is collapsing even further, down around 17% today. In fact, down nearly 50% over the last year. Over the last 10 years, they're up only a measly 5%, trading pretty much near a new 52-week low, with only Seeking Alpha considering this company a buy. And bear in mind, whilst they do pay a dividend of 1.69%, they did in fact cut the dividend not too long ago. So what was wrong? Let's just have a quick look at their earnings. Now, first thing to see, the quarter EPS came in at 62 cents, which was actually double what they had anticipated from the market of 31. Very nice to note. Their revenue also coming in very strong at 4 billion, although only marginally above the expectation of 3.98. That is still a nice double beat. However, the kicker for this company was their guidance, which was very low. The market wanted to see 64 cents. They came in and said the expectation is 24 to 34. That is a massive drop, and you could argue somewhat that this is warranted, maybe not to this degree, but this is a company that has been struggling for quite some time. If we look at the expectations as well, it doesn't look the greatest. They are expecting double-digit decrease to the EPS year on year. However, a company like Estee Lauder, they have consistently outperformed what analysts have targeted, and we can see based on June 2026, the forward P does sit somewhere in the 32 region, which for a company like Estee Lauder, not a lot of good news in terms of the numbers and the external factors, may be looking very, very costly. If we take a look at the valuation aspect then, they are trading at a significant premium to the sector, in fact around 230% worth, but they are also trading at quite a significant premium to their own 5-year average, which has been very high. And if we are to look at their growth, probably not warranted why they're trading at this level, both on a year-on-year aspect and forward-looking, we are talking pretty much flat and negative 1%, and the EPS over the next 3 to 5 years is expected to grow at around 10%, but as we can see, the sector of 7.5 is lower, but their 5-year is higher. So nothing really standing out that maybe would make us believe this company is worth the price, but we are going to get to our own valuation shortly, so let's not get ahead of ourselves. Profitability, a B+. Gross margin, it does look good at 72% above the sector, only marginally lower than their 5-year average. Bottom line though, not great at all, 1.3% below both comparatives. Then when we take a look at the cash generated from operations, it does look good. It is just above 2 billion above the sector, and it is marginally lower than their 2.555 5-year point. In terms of the company, well, dividend, even after the cut we can see here of 47%, still looks to be unsafe. And whilst we won't look at dividend yield theory given the cut we have seen, we can point out that based on the forward PE, they aren't too far off their 5-year average. Main thing though is we want to understand in terms of the valuation, is it a good deal right now? And our intrinsic value does come to around $87, which when we do use a margin of safety, bearing in mind you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Estee Lauder or any others. We keep going as we normally do until we get near the price, and 20% is what is expected of this company based on the value of around $70, and Wall Street do see upside of 14%, price target $80 by the end of 2025, but their earnings just isn't looking good. They are lowering their expectations moving forwards, and therefore maybe either you want a large MOS or perhaps this company just doesn't sit within your own investment portfolio as well as your own investment thesis. Again though, do let us know below. We then move on to PayPal, which is down around 10% after their earnings. Now over the last year they are up around 45%, looking good, outperforming the S&P. However, over the last 5 years they're down around 23%. We can see in fact quite some way away from their all-time highs around $310. Right now, trading in the upper end of the 52-week range, we do get a strong buy rating from Quant and a double buy from Seeking Alpha and Wall Street. We will point out though, unlike the previous two, it doesn't currently pay a dividend. So what about their earnings? Well, we can in fact see their Q4 earnings was a very strong beat as growth picks up specifically in relation to Venmo. And if we do take a look at the numbers that they did hit, 119 on the earnings per share, nice to see, above expectation of 112, revenue 837 above expectation of 826, and for the next quarter they do anticipate EPS somewhere between 115 to 117, which is also actually higher than market expectation of 113, and they expect the full year, again as we can see, to come above what the market is expecting. So that's looking very good, but we also quite like the fact that they've announced a new 15 billion share buyback program, especially for a company that doesn't pay a dividend. It is a nice way to return excess cash to investor pockets, and revenue is up around 4% from the same quarter last year. We can also see their total payment volume, which they say here as an indication of how digital payments are faring in the broader economy, was however short of estimates, coming in at 437.8 versus 438.2. That is again what the market had projected. So the earnings at a quick glance did look good. We do see a bit of inconsistency looking at the historical performance as well as moving forwards, but right now this company is trading at a forward P of 18.3. When we take a look, valuation, they get a D+, because the sector as a whole trades significantly lower, so you are paying around a 69% premium. However, one thing to note, it is trading significantly lower than their 5-year average, around 35.4%. In terms of the growth, they get a C+. 8%, yes, it is above on a historical performance against the sector, but lower than the double-digit rate of the last 5 years, and moving forwards pretty much in line with the sector, but quite some way away from the 14% we have seen from this company, and the EPS not looking too great at 12%, because whilst it is above the 10% of the sector, we can see again falling short of the performances of this company from the past. So question is, has the growth story started to slow down for PayPal? They get an A on the profitability, gross margin 40%, lower than both comparatives as we can see here. Bottom line, whilst it is lower quite a bit than the sector, not far off their 5-year average, but they get a massive A+ on the cash generated from operations, quite a lot, under 8 billion, significantly better than both these two comparatives. Now, they don't pay a dividend, so we don't have the dividend safety to run through. So getting straight to the intrinsic value, we see this around $104. And if we do take a look, bearing in mind, all three analysts do consider this a buy, Quant even with a strong buy rating, not at 25% level just yet, sitting somewhere between 20 to 25. Wall Street, they like the company. They see this around $100 by the end of the year. That is upside of 21%. Let us know, maybe you hold this, maybe you are looking to buy on the dip we have seen. We then move on to Pepsi with maybe a less dramatic drop than the previous three companies, down 3%. They are trading down 15% over the last year. Over the last 10 years, not the greatest, up only 51%. Right now, trading towards the end of the 52-week low, we do get a triple buy rating across the board with a yield that soon could be touching around the 4% point. So how was their earnings? We can in fact see they did beat estimates. However, we are noticing the demand for drinks and snacks dropping in North America, something I feel we have been reading about over the last few quarters. So in terms of looking at the numbers, earnings per share was a beat, something we do typically see with PepsiCo, but their revenue, as noted, has come under, although only marginally, and the bottom line does sit right now around $1.11 per share, which is higher than the same quarter last year at 94 cents. In terms of the company's organic revenue, we can see that up 2.1%. Bear in mind though, if they're not getting at least 4%, that isn't keeping up in line with inflation, and their worldwide volume has increased by around 1% for foods, as well as 1% for beverages. However, the demand is getting weaker and weaker in the company's home market. Essentially, consumers are either purchasing less of their products or moving away to cheaper alternatives, something again we have mentioned on previous earnings for PepsiCo. So again, we need to understand, do we see this as a short-term issue or something that could continue over the longer term? We also noticed some of their segments, in fact, their Frito-Lay has dropped down around 3%, but as we said, historically their numbers are good. Moving forwards, they do expect growth, but again, nothing too large, with a forward P right now sitting at just below 18. In terms of the valuation, they get a D. We noticed two things. Firstly, they are trading above the sector by around 15%. However, in terms of what they typically trade for, a forward P of 24, they are at a discount to their own average by around 23%. But as noted here, on pretty much the majority of valuation metrics you use, when you compare this company to the sector, they do trade at quite a large premium. Is it worth it? Well, look, it doesn't look to be, given the growth is a C-. Revenue over the last year flat, over the next 12 months expected below inflation, and while we do note that is above the sector median, it is below their 5-year 5.5%, and the next 3 to 5 years isn't going to look any stronger according to analysts. 5% growth, with both two comparatives sitting around the 7.5 region. If we were to look at the profitability, that might be their saving grace. Gross margin 55% above the sector median as well as their comparative, although very, very marginally. And the bottom line 10.2% above sector again, but pretty much in line like we saw with their gross margin. Cash from operations, no surprise though, does sit very high at 12 billion, above both comparatives. In terms of dividend safety, one thing we forgot to mention though is that they did do a dividend increase today by around 5%. The safety itself, 93, very safe. They are also a dividend king, 50 plus years of consecutive increases, and as we said, the yield now nearly touching 4% is well above their 5-year average, and the forward P sits well below their 5-year. That is a double undervaluation signal. Valuation itself, $170 is where we get to today, and as we keep going, not at the 20% level just yet, pretty much around the 15%, around 145. Wall Street themselves do see upside, a little bit lacking at 14%, price target 167 by the end of the year. As always though, do give us your thoughts in the comments. Don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells. We have made some purchases and sales just over the last few days, and have a great day. We'll see you all on the next one.